It's Stock Curry. I am a former investment bank analyst, and now I am producing videos for you guys, analyzing stocks here for you. I have over 20 years of trading experience, and in today's video, we're going to talk about why we are guaranteed to get an upcoming recession, as well as go over some of the historical data, what it all means for you in the stock market. So let's get into it. But before we do, I do want to remind you that I am not a financial advisor. Nothing I talk about today is a recommendation to buy, sell, or hold any asset. These are just my opinions, which may or may not be accurate. So please do your own research before investing in any asset. All right, let's talk about the market real fast. If we go back and we look at the historicals in the stock market, what you're going to notice is 100% of the time, when inflation rises above 5%, the Fed is going to jump in and raise interest rates. And 100% of the time, we get a recession within 18 months. So once the inflation gets above 5%, the Fed just steps in, they raise interest rates. We get a recession 100% of the time. Now, there was only one time in history where we did not get that recession within 18 months. It actually took a little bit longer than that. And that was back in 1952 during a major war. So if the United States were to enter a major war, say World War III, then the recession could be delayed by 2 or 3 years. But regardless, we will eventually get there. Outside of a major war, within the next 18 months, we are 100% guaranteed to get a recession. Now, what does that actually mean? Well, it's very important to understand that a recession is a technical term, just like a bear market or anything else. And in the stock market, we have dips, corrections, crashes, bear markets. They all have technical terms, right? So like a correction is a dip in the stock market of more than 10%. A bear market is a dip in the stock market of more than 20%. But then there's certain realities that kind of go along with that. Like, for example, if the stock market were to drop 19% and enter a correction before start going back up versus dropping 20% and enter a bear market before it started going back up, would you really notice the difference between a 19% drop and a 20% drop, or in this case, a correction versus a bear market? Would you really notice the difference? And the answer is probably not. To you, it doesn't really matter if it's a 19, 20% drop. It hurts the same. And when it comes to a recession, it's kind of the same thing. A recession is technically a 2 quarters in a row of the GDP growth being negative. That's what it is. So what does that actually mean for you and I? Well, in the way the GDP growth is calculated, it is the GDP growth minus inflation. So there's 2 different types of really important recessions, right? We have true negative GDP growth, meaning the economy is actually contracting, it's getting slower, it's not growing at all. Regardless of inflation, the economy is going backwards. Now, those kinds of recessions are like what we saw in 2008, where it was a major financial recession and things got really bad for a lot of people. A lot of people laid off, housing prices go down. I mean, it was really bad. And then we get paper recessions, which are far more common. And a paper recession just means that inflation is exceeding the GDP growth. Now, the important thing to understand here is that the GDP growth is still growing. The economy is still growing. The country's still getting stronger. People still have jobs. Everything's still going well. It's just that inflation is higher than GDP growth. That's it. And so we could actually enter a paper recession. In fact, a lot of people think we might have already be in a recession. And people won't even notice it. We won't really feel it because the economy will continue to grow. Jobs will continue to be added. People will continue to go out and buy things. So even though we have a 100% chance of a recession, it doesn't mean that you're necessarily going to feel it or that it's going to tank the stock market or anything like that. It just means that on paper, we're going to have 2 quarters in a row of negative GDP growth defined by the GDP growth minus the inflation. And the reason that it really looks like we're about to get a recession is simply because inflation is so high. The odds of the GDP growth exceeding 7% is very slim. And so it really increases the odds of us getting a recession. Okay, so that's what's going on with that. So when you start hearing people say, hey, we're about to get a recession, yeah, we are. We absolutely are. but it doesn't necessarily mean that you're going to be affected by it. Now, the other thing I want to talk about is there's been a lot of confusion. A lot of people are very bearish right now, talking about a bear market. And then there's other YouTubers saying, look, every single time the stock market goes up, within 3 to 6 months, the stocks have rebounded and they start going up again. So should we really be concerned about, an upcoming interest rate rise when we know stocks are going to rise and everybody's going to be fine? And what I want to point out to that is every single time I see a YouTuber bring up that statistic, and it's true, it's absolutely true. 3 to 6 months after the Fed raises interest rates for the first time, the stock market will generally rise and start going up. But here's the thing. What those YouTubers always fail to mention is what happens prior to the interest rates rising. And so it's very possible, we still have another 5-6 weeks to go. It's very possible that the stock market could enter a full-on bear market before the Fed starts to raise interest rates, or we could get really close to a bear market and then a month or two later officially enter the bear market. Keep in mind that a bear market is just a drop of 20% or more. So we already have the Russell 2000 in a bear market. We have the NASDAQ pretty close, down about 16%. The S&P and Dow aren't quite even to correction territory yet, which would be a drop of 10%, but they could get there. So just keep in mind that even though it is 100% factually true that 3 to 6 months after the Fed raises interest rates, the stock market will go up, prior to that, we could still enter the bear market. And so I think that it's all going to line up. I have been saying that a bear market will last anywhere from 3 to 18 months. That's true. I think the bear market that we are going to get in 2022 will last anywhere from 3 to 9 months. And interestingly, that lines 100% up with the stock market going up 3 to 6 months after the Fed raises interest rates. So if I think the bear market, which started in the beginning of January, is going to last 3 to 9 months, and the Fed raises interest rates 3 months into the year, and the stock market will rise 3 to 6 months after the Fed raises interest rates, you start doing the math, you realize the stock market's going to rise 6 to 9 months into the year. And that lines right up with my prediction of a bear market lasting 3 to 9 months. So all of the historical facts, all of the historical analysis is pointing towards a bear market that is going to end 6 to 9 months into the calendar year. So that's what we're looking at. Now, all of that said, obviously the question is, well, how does that apply to you? Should you buy the dip? Should you wait? What do we do? And so for me personally, I think it really depends upon what stock you're looking at. If you're looking at a stock that's already dropped a ton and it was trading at a PE of 30 and now it's down to a PE of 10, okay, now we have a value stock. It's probably going to recover faster than some of the other stocks. Those are the things I'd be looking to buy the dip on. And in fact, I'm going to talk to you guys today about one stock I did just basically buy the dip on. I actually use an option, but we'll get there. And then in addition to that, there are other sectors that you would want to invest in that will perform extremely well during rising interest rates, including banking stocks and gold stocks and things like that, consumer goods. There's quite a few of them, energy, things like that. So there's plenty of stocks that you can invest in that should continue to rise even as the Fed raises interest rates. And then there are other stocks that you might have to wait on. So maybe a stock is a large cap stock still trading at a PE of 30 or 40 or 50. Those you might have to wait to buy the dip on because they haven't actually dipped yet. So it's going to be very stock independent as far as what you do, as far as either buying a dip or just waiting. Okay. All of that said, that wraps up the market update I wanted to give you guys. What I want to do real fast is show you 4 stocks and just go over these, talk about them real fast. And then I want to get to your stocks and I want to talk about whatever you guys want to talk about. So we're going to start with ASTR, and this is Astra Space. Now, ASTR is an orbital space launch company. And ASTR fell 20% during the day on Monday. They went from a positive 5% to negative 15%. And the problem was their very first payload launch was scheduled to go today, and unfortunately it was aborted. Now, ASTR reported an issue with the telemetry, which caused the computer to abort the launch at the last second. And ASTR ended up closing down on the day 13.7%, which means it also remains a falling knife technically. And unfortunately, there's no word when ASTR will retry their first payload launch. The second stock I want to talk about today is DWAC. This is Digital World, which is the Trump SPAC. And this is the Truth Social Network SPAC, which is Donald Trump's social network. And what I want to point out of this, I've actually got to pull up like a 5-minute chart so you guys can see this. So DWAC starts the day up and it's going extremely well. And then all of a sudden, you get this massive drop. So what happened? Well, DWAC had a sudden 15% drop after it was announced that the Truth Social platform would be delayed. Now, originally they were going to launch in February, and that's no longer the case. So I also on this, I want to remind you guys, just when you're thinking about risk, I want to remind you that DWAC, because it is a SPAC, the nominal value remains $10. Now, DWAC is currently trading over 800% above its real value. So be careful because DWAC could very quickly drop by 90% if something falls apart with this deal. So be aware of that and be careful. If you buy in right now, you're buying in at 8 times the actual value of the stock. It'd be like if you, had a PE ratio of 800. If you're comfortable with a PE ratio of 800, go ahead and buy the DWAC. If you think a PE ratio of 800 is insane, you might want to stay away. Okay, the next stock I want to talk about is FB, and this is Meta Platforms, formerly known as Facebook. And what I want to point out on this is that, if you've been watching my videos for a while, I've been saying FB would fall down to around this support level here at $223 or $224. And FB actually reached that level on Monday. As you can see here, it bottomed out. And I'm going to pull up the 5-minute chart as well. And you'll see literally right here, it literally hit the line and then bounced and recovered. And then it hit the line again at the close. So I personally think this is going to go ahead and recover and go back up. This is a very strong support level for FB. That support level goes all the way back here to about January of 2020. So it's about a 2-year support level on this particular stock. And so basically when it reached that bottom and kind of bounced on Monday, what I did is I ended up selling a credit bull put spread on FB. And those credit bull put spreads that I sold will hit max profit so long as FB closes at or above $225 on Friday. By the way, guys, if you want to know everything I buy and sell within minutes of making the trade, I post all of my buys and sells free of charge on Twitter. You can just go follow me on twitter.com/realscottcurry, and you can get every single stock that I buy and sell free of charge. Okay, the last stock that I want to talk about is PTON. This is Peloton Interactive. And as you can see, PTON jumped 20% on Monday. So, okay, obviously this is still a falling knife. Technically, 20% sounds like a lot until you realize it's still down like 90%. But anyway, it did jump 20%. And the reason for the 20% jump is because there are multiple rumors that multiple companies are looking to buy out Peloton. Now, that said, I want to be clear that insiders say this talks are preliminary and that PTON has not started any formal conversations to sell the company. So despite Monday's massive run-up of 20%, PTON remains bearish on the technicals with no confirmation of a rebound. So just keep that in mind. 20% run-up was good, but this could still continue to fall. Okay, that is going to wrap it up with everything that I wanted to talk about. And let's go ahead and head on over to the comments and see if there's anything that you guys wanted to talk about. Just a quick reminder, if you're not already subscribed and following me on YouTube, you can do so at youtube.com/stockcurry. I also have a backup channel on Rumble. So if anything ever happens to YouTube, they, take me off the platform or anything, you can go to rumble.com/stockcurry and follow me there. And then the other thing is we also have the free We Profit Day and Night Discord at stockcurry.vip/Discord. With that, there's just a real quick application you got to fill out to get in. But the truth is, every single person who applies gets in. I just have the application there to help prevent scammers. And then, of course, don't forget to hit the like button and subscribe. That'll help out the algorithm there so that more people can see this and get the great information. Okay, let's head on over to the chat and see what you guys have to say. And like I said, we're gonna do about 15 more minutes here, and then we're gonna end it because I don't want this to go too long. So as far as individual stocks, I'll have to look to see if I got more than one person asking about it. So let's see. We've got SOFI would be the first question we've got. So let's go take a look at SOFI, and we'll just do some quick technical analysis on here. Now, fundamentally, you have to understand that SOFI is a fintech company, which means they're going to be hurt by rising interest rates, especially if consumers spend less money or, more importantly, do less transactions, which means they buy things less often. That's where SOFI is going to get hurt. But longer term, SOFI did just get their bank charter. And so with SOFI being approved for the bank charter, that is going to be extremely good long term because it's going to significantly improve their profits. So for a long-term investor, SOFI is at a great price right now. Wonderful, wonderful price to dollar cost average in. But technically, you got to understand that in the short term, SOFI remains a falling knife. So just be careful. I wouldn't just jump all in right now. I would dollar cost average in. So if it drops a little bit more, you'll get a little bit better price. And if it runs up from here, well, at least you will have bought some at the bottom. Okay, let's see what else we've got. So we talked about that already. Yep, we got SOFI in there. So, okay, let's do an options question. So DWAC, the question here is, should you sell a bear call spread? Now, a bear call spread is going to make money if the stock goes down. And here's the thing. If you look at the technicals, this remains 100% bullish. Betting against DWAC is kind of like betting against, I don't know, AMC or GameStop. You're betting against very strong retail momentum. And personally, I would never bet against retail momentum. Retail traders don't care. They'll run this thing up to $1,000. They do not care. So no, I would not sell a bear call spread on here, even though fundamentally it makes sense. When you're dealing with something like DWAC or AMC or GME, the fundamentals don't matter. So I wouldn't bet against the retail investor. That's for sure. Never bet against the retail investor. Okay, let's see what else we've got. So PTO inputs. Let's talk about this. So first of all, if a deal falls through, yeah, maybe. But the problem is at any point, Bloomberg could come out with some article saying, hey, we talked to an insider and the talks are no longer preliminary. They're now formal discussions. And we can see PTON jump to, $40-$50. So just be careful with that. PTO inputs, they might make money, but I feel like they're kind of dangerous. So keep that in mind. Let's see what else you guys have got. We're going to get through these kind of fast just because we've got, I've got to get to bed here. So 10 more minutes and then we'll end it. Trying to see if there's anything else we've got more than one person asking about. So give me a minute here. Let's see. All right, so we got a couple of questions on this one. XELA. Let's take a look at this one. So I'm not super familiar with this penny stock, so I can't really talk to you guys about any of the fundamentals here. I can see that, you know, for a penny stock, I would like to see some revenue growth, and we're not seeing that. So that's very, very bad, especially for a company that's not making any money. You don't want to see declining revenues. Uh, Fundamentally, this stock is complete crap, but you got a price to sales ratio to match 0.03. Yeah, that is so. Fundamentally, it's dirt cheap, but it continues to lose money. Let's see how long it can last before it just completely goes out of business. We've got $146 million in cash. Let's go take a look at the debts. We've got no short-term debt. Long-term debt, 1.34 billion. Ouch. Yeah, this company's balance sheet is complete crap. The income statement is complete crap. I can see why this has a price to sales ratio of 0.03. It's deserved. Fundamentally, I wouldn't touch this thing. But, you know, let's go take a look at the technicals and just look at it for a possible short-term trade. We already had a golden cross, which would be confirmation. The actual lines are still below the histogram, so plenty of room to move up. Your RSI is at 50, so we're really about the halfway point. Plenty of room to move up. We had a 10-day EMA cross above the 21-day EMA, which is also bullish. So we got bullish, bullish, bullish with plenty of room to run up, plenty of room to run up, and plenty of room to run up. Technically, this is short-term 100% bullish. Long-term, I wouldn't touch it. So there's XELA for you guys. All right, let's see if we got any others. A couple of questions on PLTR. Take a look at that one real fast. So, you know, PLTR is unfortunately technically a falling knife right now. Still kind of expensive on the fundamentals. Actually, it's still really expensive on the fundamentals. Not kind of, really, like double. But let's go take a look at our growth. And I mean, growth remains massively good. The problem, though, is that it's fundamentally still kind of overvalued. I used to love PLTR for a swing trade because it would like come down and bounce and come down and bounce, come down and bounce, come down and bounce, come down. But at this point, once it stopped bouncing, it's over. The swing trade is over. The bullishness is over. And it's just 100% technically bearish. This is one of those stocks that will not perform well during a bear market, and it will not perform well during rising interest rates. So this is one I would probably just wait another like 6 months, let this thing bottom out before jumping in. All right, got about 6 minutes here. All right, so we have a super chat. Thank you, Ray, so much for the $5 super chat. And you say on FB, let's just go ahead and pull up that chart real fast. Do you suppose FB could reach $700 by January 2024? I mean, I suppose anything's possible. Is it likely? No. The problem with FB, it's kind of good and bad. In the short term, FB is in a really bad place right now. So in the short term, and when I say short term, I'm talking like the next 2 to 3 years. The problem with FB right now is that they are losing user engagement from their main platform, which is Facebook. And that's going to continue to go down as TikTok and other platforms kind of take over. So FB is going to continue to lose revenue probably for the next 2 or 3 years. Now, once their meta platform, whatever that is, launches and starts to take over, I mean, Facebook is, or FB, Meta, whatever you want to call this thing, they are going to be a first player. They're going to have the first player advantage. And so, really, I think 2, 3, 4, 5 years from now, once their Meta platform launches, FB is going to absolutely take off. It's going to skyrocket. But we're probably going to have about 2 years of pain before we get there. So, do I think it's going to reach $700 by January 2024? No, I don't think that's going to happen. Do I think it'll hit $700 eventually? Yes, but I think it's probably going to take about 5 years. So thank you for the super chat, and best of luck with your options. All right, DIS. Okay, I covered DIS in yesterday's video. Just go watch yesterday's video. You'll get my thoughts on that. Okay, let's see. I already talked about DWC. I already talked about that. Let's see. All right, I've had a couple of questions on CRSR, so let's jump into this real fast. Look, Corsair Gaming is dirt cheap right now. Fundamentally, it is dirt cheap. If we take a look here, we have a price to sales ratio of 1, which is a value stock pricing. We have a PE ratio of 14, which is a value stock pricing. And check this out. Look at the fundamentals. Okay, yeah, I know they had a bad quarter last quarter, but historically, this 17%, 55%, and look at the quarterlies, 70%, 70%, 24%. Guys, this stock is a massive growth stock that's priced like a value stock. Fundamentally, this stock is dirt cheap. The problem is technically it's still a falling knife. So technically this thing could continue to go down. And if I pull up CRSR over here in Ortex, what you're going to see when I pull up the short interest on the sucker, utilization's at 82.99. Now, actually, that's good. That means shorts are covering. Let me pull up the historical utilization, and you can see that it's dropping. So over the past couple of months, shorts have been covering on CRSR. And when shorts cover, what that means is they think the stock is bottomed out and it's not going to go any lower. So this is a really good sign that CRSR is probably at a bottom. Will probably start going back up again. Let's just take a little bit closer look and see if we can see how the actual number of shares has been changing hands as far as short interest and availability here. So recently we see 650 rising to 800. So again, shorts are covering. So this looks really, really bullish on CRSR. As far as the short selling, fundamentally, it looks like we're probably at a bottom here, but technically it is still a falling knife. So love it, love it, love it for a long-term play, but you might still get a little bit of short-term pain. All right, we got about 2 minutes left. Let's go see if anything else that people have been talking a lot about, as in like more than one person. So I'm just going through, checking here. I don't see a lot more with 2. Let me just see if there's any other questions that aren't specifically stock related. All right, as far as banking stocks that I buy right now, I still love Citigroup and Goldman Sachs. Those are my 2 favorites. Let's see. Okay, so I don't really see any other, duplicates or whatnot. Oh yeah, you know what? I'm sorry. Hold on, this guy right here. Twitter. I wanted to talk about this real fast before earnings, and I missed this on a prior video. So we'll talk about this real fast, and then we're going to end it. So here's the thing about Twitter. If you look at the technicals, it's a falling knife, right? If you look at how far it's dropped from 80 to 36, obviously it is an extreme bear market territory. I mean, it's down 50% from highs, over 50% from highs. But I want to go look at the fundamentals real fast on Twitter. And what I noticed personally, just using the platform, is that Twitter has quite a few new revenue streams that they have launched over the past couple of months. Now, I don't know if those revenue streams are going to show up in their Q1 numbers or not, but I do think that they will, at the very least, provide good forward guidance based upon their 2 new revenue streams that they've introduced. So as far as Twitter earnings, I am bullish on it. I'm actually thinking maybe a call option would be a really good idea on Twitter here. Just to give you an idea, Twitter is reporting earnings. I think it's on Wednesday, and I think it's after the close. So you still got a little bit of time, but I do plan on buying call options on TWTR. I am absolutely bullish on it. Okay, that is going to end it today, guys. I'm going to go to bed. I've got a very long day tomorrow. I hope you guys have a lot of success trading. Thank you, everybody, for joining the live stream. And just one final reminder, please make sure you subscribe if you haven't done so already and hit that like button. And if you're on Twitter, go ahead and follow the page also. Thank you guys so much for joining, and I will see you guys all